everybody wants money while they sleep, and crypto promised exactly that. Just stake your coins, sit back, and watch the yield roll in like some kind of digital landlord. But what if the whole passive part was the biggest lie sold to you since someone convinced you that a timeshare was an investment? Let's talk about what's actually happening under the hood. Because staking isn't your savings account quietly compounding at the bank, it's you locking up your assets to help validate a blockchain network, and in return, you get rewarded with more of that same coin. The catch is that the coin you're earning could be losing value faster than you're accumulating it, which is a bit like getting paid in monopoly money during a house fire. The hype was real back in 2021. People were screaming about 30, 40, even 100% annual percentage yields, like they'd cracked the matrix. And influencers were posting yacht photos next to yield farming dashboards. Now, those same protocols have either collapsed, been drained by exploits, or quietly dropped their rates to something that would barely cover your Netflix subscription. The psychology here is fascinating and brutal, because nothing makes a person ignore risk faster than seeing a number with a % sign next to it, especially when their neighbor is bragging about it at a barbecue. Behavioral economists call it yield chasing, and it's the same instinct that made people buy tech stocks in 1999. The brain sees reward and temporarily disconnects from the concept of loss. Here's the technical reality that most yield tutorials conveniently skip. When you stake or lend crypto, you are exposed to smart contract risk, liquidity risk, counterparty risk, and in many cases, forced lockup periods where you literally cannot exit even if the market is collapsing around you. It's not passive income, it's active risk management, disguised in a hoodie and called DeFi. History has a pattern here that's almost poetic in its repetition. From junk bonds in the 80s to mortgage-backed securities in 2008 to algorithmic stablecoins in 2022, whenever someone promises you yield that seems too good to be true, with minimal explanation, the explanation is usually that you are the yield for someone else. Luna and Terra wiped out tens of billions of dollars in weeks, and thousands of people who thought they were just earning passive income woke up to essentially nothing. Let's also kill the misconception that centralized lending platforms, like the ones that collapsed in 2022, were somehow safer because they had a website with a logo and customer service. They were running fractional reserve models with crypto assets, and when withdrawals spiked, the liquidity wasn't there. Celsius, Voyager, BlockFi, these weren't fringe experiments. They were mainstream platforms with millions of users, and they all went under within months of each other. Now, to be fair, not all staking is created equal. Staking on a layer 1 blockchain with a long track record, like Ethereum post-merge, is genuinely different from depositing into some new protocol offering 300% APY that launched last Tuesday. The former has real network utility, real validators, and a more transparent risk model, even if it still carries volatility and technical risk you need to understand before committing. The practical lesson from every cycle is the same. Never stake or lend more than you'd be comfortable watching go to zero. Because in crypto, zero is always on the menu, even when it's not listed. Position sizing isn't just a trading concept, it applies to yield strategies too. And the people who survived the 2022 wipeout were the ones who treated these as speculative allocations, not retirement plans. Process beats conviction every single time in volatile markets. And that means having a written plan before you enter what's your unlock timeline, what's your exit trigger, and what percentage of your portfolio is genuinely at risk if the protocol fails. The traders and investors who consistently come out ahead aren't the ones with the best picks. They're the ones with the most disciplined frameworks that remove emotion from the equation. There's actually something almost philosophical about the word passive in this context. Because nothing about monitoring smart contract audits, tracking tokenomics, and staying aware of regulatory changes feels passive. It feels like a part-time job that doesn't pay overtime. True passive income is boring, predictable, and usually involves owning something tangible that other people need, which, ironically, brings us back to asset classes that have been working for centuries. What crypto staking and lending really are, at their most honest framing, is a risk premium. You're being compensated because you're taking on real risks that the market has priced. And sometimes that premium is worth it, and sometimes it isn't. The discipline is in knowing the difference, sizing accordingly, and never letting the number on the screen override the logic in your head. We're comfortable with any outcome here, whether crypto staking evolves into something genuinely reliable or continues its tradition of dramatic collapses, because the framework stays the same. Understand what you own, know your risk, and never let greed write a check your strategy can't cash. Preparation isn't pessimism. It's just playing the long game with your eyes open. If passive income is genuinely what you're after, it might be worth exploring assets that have been generating it reliably before the internet existed. And if you're curious about real estate investing, home contracting opportunities, or connecting with the right lenders to get started, check out our links in the description below.